Alrighty, it looks like our numbers have leveled off a little bit. Good morning. My name is Carlos Anchondo. I'm a reporter with the Energy Wire team at ENE News, based in Washington, D.C. Today, we're here for the panel discussion, Walking the Talk. Is there a linkage between oil and gas companies' announced CO2 ambitions and their upstream project portfolio management? To talk about the proliferation of climate targets put forward by oil and gas majors, especially as those firms face increasing pressure from both shareholders and the public to address climate change in a meaningful way. This event is, of course, being run part of Climate Week. I'd like to remind everyone that Carbon Tracker is also hosting a webinar on Thursday at the same time on the future of plastics demand. As we know, targets are not the same at every company, and we've seen European oil and gas companies put forward more aggressive plans than their American counterparts. In recent months, for example, we have seen European supermajors, including Equinor, Royal Dutch Shell, Repsol, and BP, lay out their respective net zero carbon plans. And this comes as last week, during BP Week 2020, the company said it expects for oil demand in a business as usual scenario to plateau over the next 20 years. It plummets if governments really move to tackle climate change. Nevertheless, recent reports, including a discussion paper released this morning from the group Oil Change International and more than 20 other environmental and finance organizations, say that none of the climate strategies or plans of the largest oil and gas majors are enough to align with the ambitions of the Paris Agreement. That follows reports from Carbon Tracker itself, which has said that companies could see new oil projects lose value under a so-called handbrake turn scenario in which governments really buckle down on steps to mitigate the impacts of climate change. Amid that backdrop, we have Carolina San Martin and Andrew Grant to help us make sense of things. Carolina is the Director of ESG Research at Wellington Management, where she leads their environmental, social, and corporate governance research team and oversees the firm's ESG research and stewardship activities, including its company engagement and voting efforts. In this capacity, Carolina works to make sure that the firm's ESG capabilities meet the needs of its global clientele. She also works closely with investors across the firm to identify and assess ESG risks and opportunities in client portfolios. Andrew is the head of oil, gas, and mining at Carbon Tracker, which he joined in 2014 as a senior analyst. Andrew has authored a number of reports for the group, including its Carbon Supply Cost Curve series, exploring transition risk at the company level, and analyses of the oil refining industry. Andrew is also a senior advisor to Critical Resource, a management consultancy that specializes in political, stakeholder, and sustainability challenges in energy and mining. Andrew is going to kick things off for us today, followed by Carolina. Then we'll have plenty of time for a Q&A period. Questions submitted via the Q&A box can be accessed via the bar at the bottom of your Zoom screen. And only questions submitted in that Q&A box will be considered. So please look for that option on your screen, and I'll do my best to pull from those questions later on during the Zoom. And I'd also like to remind everyone that this webinar is being recorded. So Andrew, we'll have you get us started.
Great, thank you very much, Carlos. So what I'll do just to begin with is just to start off with some of the basics. So apologies if this is old news to everyone, but I think just worth framing the issue. So I guess the first thing to mention, and this is something that frames a lot of Carbon Trackers thinking on this topic, is that around the concept of some really finite limits of the planet. So when you're thinking about that in the context of global warming, ultimately the way the science works is that global warming is driven by aggregate greenhouse gas emissions. That's what's known as a carbon budget. So you can say for any global warming level, 1.5 degrees, 2 degrees, what have you, there's a certain amount of CO2 you can emit for that level. And if you get to that stage and you're still emitting, then the temperature is unfortunately still going up. So in order to get to stabilised temperatures at any level, whether it's 2 degrees or 5 degrees, you need to get to net zero at some stage. So, and I should also mention that for 1.5 degrees, that high end of the Paris goals, net zero is typically reckoned to need to be around 2050. So, varying by scenario level. But what this really points out is the need to limit emissions in absolute terms, and to deliver really quite steep drops, which will then in turn imply emissions on the amount, reductions in the amount of fossil fuels we use. And if you're kind of assuming that we're going to use less fossil fuels, and given that we've got a lot of fossil fuel reserves out there, around about 50 years or so at current production, just improving reserves for oil and gas, and over 130 in coal, then that raises the risk that some of those assets will be stranded, or that companies that invest in those or assume they can invest in those and keep investing for growth will ultimately end up destroying value. So that's just a little bit of a background, and this is of course where the oil and gas industry comes in. I think these issues are sort of very well recognised now, and clearly the oil and gas industry is under a lot of pressure on these angles. I think you can probably disaggregate the issue into two separate points. I think clearly there's a lot of pressure on the oil and gas industry from a lot of different stakeholders, and even if you're just thinking about investors as a single blob, there's a lot of different perspectives, mandates, time horizons, so on and so forth in there. A lot of people with different views looking to achieve different things. But I think broadly speaking, you can probably boil it down to a couple of different areas. I think firstly, there's kind of the issue of alignment with Paris, or what you might call sort of being part of the solution, or being seen to be doing the right thing, pulling in the same direction as the rest of the world. There's also, secondly, more of a kind of financial risk aspect, which is more to be around avoiding stranded assets, be financially resilient, try and maximise returns during the transition. But the good news is that I think we're at a stage in history where really both of those things are pulling in the same direction. People recognise that you can sort of have your cake and eat it a little bit in this respect, in that the answer to both is the same. And if you're thinking about that in portfolio management terms for oil and gas companies, a lot of it boils down to the fact that companies need to recognise the limits of the planet that we have, those finite limits, and avoid sanctioning assets that aren't competitive under those conditions of lower demand. So in other words, they fit within a carbon budget or a production budget, if you define that on economic grounds. So in other words, if you're only sanctioning the lowest cost assets that fit in a low carbon world, not only are you demonstrating kind of alignment with Paris, but also, or certainly on that one aspect, but also that in a world where the demand is low, maybe you can still create value where your peers destroy it. And as we have seen, so this probably implies that oil and gas companies again need to get smaller in absolute terms, but perhaps not in terms of the returns that they deliver to shareholders. Now, this is something that has been called shrink to grow previously. In other words, the company gets smaller, shrinks, but grows returns to shareholders. ConocoPhillips' old CEO, Jim Mulver, coined that term back in 2010 or 11 or so, when Conoco spun out its refining business, decided to focus on its core business, and outperformed, in fact, the rest of the industry in that period. So this is something that we've seen successfully before. But of course, the climate change, transition risk, this is a very existential issue that touches on really the heart of business models for producing companies. It needs to be reflected in all sorts of different parts of the strategy. And here I think we can really see that the industry's response does tend to reflect the strategic challenges that they face and the tensions between the past of the last 100 years worth of growth against the future, where people recognise that that's a model that's going to need to change. So I think we're seeing progress, but then unfortunately there's normally caveats to that progress. So I mean, you can think about things like remuneration targets for executives tied to hitting targets related to CO2, for example, CO2 intensity, but at the same time, over 90% or around about 90% of executives at listed oil and gas companies have incentives to increase volumes of fossil fuels, whether that's reserves or production. So you kind of got one thing trying to get them to do one thing, another thing trying to pull them in the opposite direction. We see things like enhanced disclosure, for example, the TCFD regulations, but often these are drafted in very broad ways that give a lot of wiggle room. And we're still not really seeing any standards of best practice emerge at this stage. And another thing I guess we could point to is impairment targets or impairment prices that companies use. In other words, the financial long-term price assumptions that underlie companies' financial statements. Some companies, certainly we've seen over in the last year, have seen adjusting down their long-term prices, reflect it, and also mentioning energy transition as part of it. And maybe that's partly making a virtue of necessity, given the oil price volatility that we've seen in recent years. But certainly some of this was pre-COVID. And I think a crucial point here as well is that auditors are starting to look at this as well. So what we saw in the annual reports of both Shell and BP this year, that their auditors had expressly checked their price assumptions for whether they fit with the company's commitments on decarbonisation or with the kind of international climate commitments. But again, that's a couple of companies. We still see companies that have assumptions that are much, much higher. So Equinor, for example, assume a long-term oil price of $82, and the US companies don't disclose that at all typically. So the topic of this webinar, of course, was to come on and talk about some of the emissions targets companies set, even where these companies do set them. And where for the companies that are more progressive on this point, you've got to say, okay, well, there are companies starting to differentiate themselves, probably at the end of the field. But even amongst those companies, the targets and the way they set them, they're always, or so far, typically framed in entirely different ways, which makes them quite difficult to compare. But I think just to focus on this topic for a moment, I think clearly the CO2 ambitions that the European integrated companies in particular have been making are clearly a hot issue, and we're seeing something of an arms race here. So I think to return back to a previous point, I think typically when people think about these CO2 emissions or ambitions to lower their intensity or their absolute level of CO2, people are really thinking about the alignment aspect that I mentioned previously. In other words, does it really reflect the company's activities and their impact on the environment? Can they show that they're aligned with the Paris Agreement or something similar to that? But I also do think it is important for when you're thinking about financial risk as well. It might not seem to be directly related, but if a company's emissions targets are formulated in a way that do reflect those finite limits that the planet has, then perhaps that implies that the management team are more conservative with regard to sanction too. So maybe you can actually even see these slightly as proxies for each other a bit. So the potted history, I think, of the emissions targets is that Scope 3 emissions. So those are the emissions that were always that are come about from the use of fossil fuels rather than the getting it out of the ground, and typically are around about 85% of the problem, or 85% of the emissions related to a barrel of oil or a unit of gas overall. Those that previously kind of oil and gas companies have sort of not seen them as their responsibility. They kind of seen that as more the consumer's issue. Although you might be able to say that the companies probably had a pretty good idea what would happen to their production, but thinking about it in sort of quite legalistic terms, thinking about that real question of responsibility, the companies have always sought to kind of outsource that issue. We have seen things change clearly in recent years. So Shell were the first back in 2017 in their management day in November, who included Scope 3 in their targets. But the way that they laid out their ambition was on an intensity basis. So it was really around, can we lower the average carbon dioxide per joule in our portfolio, not lower the absolute amount of CO2 that we're going to produce. So that means that the target is framed in a way that can allow them to keep increasing production, as long as they sort of lower the average. So if they're still planning to increase production, then of course you're still leaving yourself open to that question of stranded assets. However, since December this year, we've really seen activity pick up here, and in particular absolute elements I think come in. So we had Repsol back then announce a net zero endpoint, which it didn't say a whole lot about how much CO2 was going to be emitted in the meantime, which is clearly a very important point. But at least by having that absolute endpoint, that's giving a bit of a grounding that relates to the reality of the planet that we live in. BP said similar, of course, aiming for net zero in 2050. But I think, aside from those emissions targets, what people really wanted to understand was that's a target for 2050. It's a long way out. It's probably not the CEO's problem, or even the CEO's successor's problem. Maybe not even the CEO's successor's problem. People want to understand, even given that long-term thing, how's it actually going to be impacting the strategy now? Because I think one thing that's very clear is that the prerogative is here and now to be showing people that you take account of these issues and that they clearly do impact the performance of your business. And we are now starting to see that. So whereas up until recently, companies had said, have been talking about the impact in production in sort of very vague terms, Equinor CEO, for example, I think said something along the lines of there would be implications for the scale and balance of their upstream production. Companies are starting to put numbers to that. So we've said ENI saying that they're going to peak oil production in 2025. And of course, crucially, I think probably everyone has heard about BP's plan to cut upstream production by quite a long way. So I mean, by 2030, which obviously isn't in the very long term, particularly when you're an oil and gas company and you're thinking in terms of decades when you're thinking about your capital allocation. So their target was to reduce upstream production by 40%. Now that excludes Rosneft, which is a very material part of their production, but it's still a very significant cut, particularly compared to a lot of what the other companies are talking about. So I think to sort of wrap up, I think it really does look like the industry is starting to diverge a bit when you look at the cost profiles of the potential portfolios that companies have, the sorts of projects they're sanctioning, the impairment assumptions that they have underlying their businesses and their financial statements, and the emissions targets that they're setting and how meaningful they are. Some companies, I think, you know, we're clearly seeing a shift. I think it's easy when you're talking about when we've got a discussion like this where we're framing it around emissions targets. Clearly, the temptation is just to talk about the leaders, but of course, we can't forget as well that before COVID-19 crisis, clearly all of these companies were planning, or a lot of them were certainly planning for growth higher than levels even beyond just business as usual demand growth, let alone a reduction that would be needed along the lines of any sort of relatively good climate outcome. And of course, all these things are very cyclical and formed by the volatility in the oil price. It's certainly much easier to plan for lower growth in a $40 oil environment than it is in a $60 environment. And there are still plenty of projects out there that can destroy value. So I think above all, it's going to be worthwhile being vigilant over time. But I think clearly, just to wind up, and before we get on to the question, we can explore some of these things a little bit more. We're seeing positive signs for sure. I think it's uneven. But the factors that drove the change, drove the companies to make these announcements in the first place are still there, and they're getting stronger. So I think time will tell. These companies that are big ships, they're going to take a little while to turn around. But now's the time that having made these announcements, what people really want to see is the detail. They want to see that people are they want to see strategic clarity essentially, and that that companies understand they get the issue, and that. When it comes down to portfolio management, it's really going to be a question of showing that you are indeed doing the things that you say and not sanctioning the assets that rely on the failure approach in order to succeed. And I'll wrap up there.
Right. Carolina, would you like to take it away now?
Yes, great. Thank you, Carlos. So what I thought I'd do is provide the investor perspective and set some context by describing our philosophy and approach to assessing ESG risks in general, and then move specifically to climate risk within oil and gas. And I can share some examples from our research and engagement as well. So just to set the context, at Wellington, we see environmental risks like climate, social risks, governance risks as that study of those risks as an investment research capability that can support better investment decisions for our clients and help us deliver on our firm's mission to exceed our clients' investment expectations. So it's really part of the investment process. And we believe that collaboration across the equity, credit, ESG, analysts like myself and my team, that collaboration across the different disciplines can really help us get a deeper understanding of the companies that we're investing in by bringing in the expertise from the different perspectives, again, to drive better outcomes for our clients. So our philosophy really comes down to two beliefs around ESG. The first is a belief that material, environmental, social, and governance issues, at the end of the day, are strategic business issues that will impact financial performance. I think the discussion that we're having today is a clear example of that. So that's why we have a dedicated team to analyze that, bring those insights to our portfolio managers, and inform investment decisions. The second is a belief that it doesn't just stop at the research. It's also about acting as our clients' fiduciaries. We see our responsibility to give feedback to companies to when they can improve. So we use the tools of voting and engagement to do that, because when we can help companies get better, not only do they get better for our clients, the ultimate shareholders will also see those benefits as well. So we're taking really an investment-led bottom-up approach to this analysis, putting the issues in the context of the investment thesis, which leads to a holistic and integrated approach to assessing companies. So how does all of this apply to the discussion today, the question of climate change and its impacts on the oil and gas sector? So I'm the oil and gas sector analyst on the team, and a key component of my assessment of these companies is how they're analyzing and managing the impacts of a changing climate and how it will inform their long-term strategy. I think Andrew started, really framed some of this backdrop well in his comments. I'd add a couple of pieces to the materiality case that I use in my framework. The first is really, in a world where all parts of society, governments, businesses, consumers, are trying to reduce the carbon placed in the atmosphere in order to avert the worst impacts of a changing climate, the market dynamics are shifting. And this is certainly happening unevenly across the globe. It will continue to be uneven, but the direction is clear. And the more evidence that we have of these harmful effects of climate change on people and companies' financial markets, I think that this will serve to accelerate this dynamic. And it will mean that low carbon sources of energy will take share from higher carbon sources of energy. And that was clearly the message from BP's Energy Outlook that was shared last week that Andrew referenced. So a second piece of the materiality case is that access to capital is being tied to decarbonization in a way that we just haven't seen in the past. And this applies not only to energy, I think it applies really to all sectors, and we're starting to see that attention shift beyond energy now. Investors really, for the first time, have the tools to measure emissions, to manage them in their portfolios, and they're looking to reduce the exposure to emitters in their portfolios, and they want to see that improve over time, not get worse, because this is the way that they can be a part of the solution to the climate challenge. So I think this is a great example of markets moving faster than policymakers, and even where there hasn't been a strong policy response to drive Paris alignment, we can still see this growing trend among investors to take action on their own by decarbonizing their portfolios. So in short, it really is becoming clear that a company's emission profile is key to its investability. And where policy isn't reflecting that currently, I think companies that act sooner in response to this investor demand will have an advantage when it does. And I think, as Andrew noted, oil and gas companies are beginning to understand that decarbonizing their business is part of their value proposition to investors, and that if they fail to address it, that it could impact their cost of capital. It's not just equity debt investors like those at Wellington, but you can see that in lending as well. Banks are increasingly appreciating these risks to underwriting the sector. That will put even more pressure on companies to reduce their emissions. So bringing these two parts of the materiality case together, this shifting market dynamics, decarbonization becoming tied to investability, and thinking also of the companies outside of energy, the consumers of the companies we're discussing today, as they become more scrutinized for their emissions and encouraged to decarbonize. Their scope 1 and 2 is the energy sector's scope 3 emissions. So I think there's a virtuous cycle that's starting, we're starting to see evidence of, that's really driving decarbonization across sectors of the economy that will feed into that demand, changing market demand for shifting towards lower carbon sources of energy. So thinking about how companies are responding to this, and I have the opportunity just to talk to a lot of companies and really study their strategies. I think there's not a one-size-fits-all approach. Companies are bringing different skills, assets, incentives to this problem of addressing the climate challenge. I do think, though, that framing it as a trade-off between generating returns for shareholders on the one hand and embracing a longer-term sustainable strategy that aligns with the energy transition on the other is a false choice, because as the materiality case for climate risk management shows, these two are linked, and increasingly investors are expecting both. There's one comment from a European energy company CEO that really brought this to life for me. He said, we want to be able to deliver to our shareholders in the next quarter, in the next year, 10 years from now, and 50 years from now. So doing this, delivering on that intention will really require adapting to energy markets that are already changing due to climate impacts and the energy transition. And what I found ultimately from ESG outperformers in the sector is that they have three things in common: strong risk management practices, long-term strategic thinking, and adaptability, the ability to evolve with these changing market conditions. And I think that companies that exhibit those characteristics should be better placed to deliver returns to our clients throughout the transition. In terms of strategy, it's really been amazing to see how different the company's approaches have been. And they're really embarking in different strategies. We think of them as peers within the sector, but I think that that's becoming harder to do as their responses to the energy transition really set them on different paths. I think the difference between the US and the European companies are pretty well understood. We're seeing a lot more alignment with the transition in Europe. I think that's being reinforced by the regulatory environment, the EU Green Deal. One surprise for me this year has been the emerging market energy companies that we speak to. Most of them are majority state-owned, but they're starting to take these issues seriously and increase the ambition of their emission reduction targets, start to articulate their strategies in the context of the energy transition. And I want to be clear, efforts have been primarily focused on reducing operational emissions, scope 1 and 2, rather than shifting business models like the examples we're starting to see in Europe. However, in some cases, these targets have been more ambitious than what we're seeing from many companies in developed markets in the US, for example. And we're starting to see some of the players improve transparency around scope 3, something we really haven't seen at all among the US companies. And they're acknowledging, employing scenario analysis that there is, there could be opportunities to aligning with the energy transition longer term. And it's notable that all of this in emerging markets, as well as happening with the backdrop of COVID, and even in countries where there hasn't been meaningful climate policy. There are a couple of examples I can share to bring this to life. We were able to engage with the management team of an emerging market national oil company earlier this year in our Boston office before the travel was shut down to the US. And in this meeting, the CEO of this company made a passionate case for investing in decarbonization of their operations. It's a new strategy for them. Over the summer, we followed up in a virtual setting like this. We asked whether this challenging environment since our last meeting had impacted their plans. And the answer was an emphatic, absolutely not. And they pointed to having learned their lesson from stepping away from some of their sustainability goals in the 2014-15 downturn, and how much that impacted their investment case for investors. So they learned that lesson, and while they were having to pull back on some of their investment plans, those focused on reducing their operational emissions was not among those. Another state-owned EM producer updated its climate strategy over the summer, and they not only raised their ambition of carbon reduction goals, but they also announced for the first time that they plan to invest in acquiring the skills and technology it needs to diversify into renewables longer term. Now, this is coming short of a strategic plan shift, but it really put on the map for them that they were considering this, that their scenario planning was informing that. And there's a quote from that report I wanted to read because it really, I think, summarizes it well. They said, due to the intensive capital nature and long cycle of our business, considering carbon properly in the governance, strategy, portfolio management, risk evaluation, metrics, and other processes will be fundamental to increase our competitiveness. I really think this captures perfectly this first tenet of our philosophy, this materiality case that we're speaking to today, and really highlights how long-term strategies to address this issue are going to put companies in a better place over time.
Great, thank you both. To start off, I wanted to expand on that point. And speaking of adaptability, we've obviously seen a tremendous amount of change over the past, 6 to 7 months. And so I know you just gave two specific examples, Carolina, but maybe you could kind of expand on just, how companies are impacted by the coronavirus and, what that means for their ability to make good on some of the targets that they've set.
Sure. So like these examples, I think that they really highlight that in the investor sentiment, this pressure that companies are feeling from investors and the need to remain investable in the context of climate concerns has led companies to reaffirm commitments despite the challenging environment rather than backtracking. And I think part of the context here too is that in many ways the pandemic has been a sort of dress rehearsal for the strains on society, governments, companies that the physical impacts of climate could present. All while we are actually seeing evidence of this of those impacts today with the tragic fires in the West Coast, Australia last year. So I think all of this really just strengthens the case for continuing to set these ambitions, and backtracking, I think, is simply not an option. But as Andrew alluded to earlier, I think what's really critical here is not only to maintain, reaffirm those ambitions, but demonstrate progress over time. And that's where investor attention is really going to come to next.
Andrew, did you want to weigh in there?
I'd really just echo those comments. Really, I think obviously the companies will have less cash to spend. That's a clear implication. Shell, of course, had a big plan to return a lot of capital to investors via buybacks and via dividends, but of course that was dependent on the oil price, so they haven't been able to deliver on that one. We'll see big cuts to capex budgets, but the spend around the shift to renewable energy does seem to have been more resilient. And of course, this is the whole thing has reminded everyone of the benefits of not being quite so highly dependent on volatile commodities. But this is really it's a big social license to operate issue. Implications of capital access, as mentioned, and it's not like climate change is going away. So if companies can't still afford to stop acting because it's going to be there when we come out of the other side, and by which time they could just find themselves behind their peers. I guess one thing that this sort of extreme volatility sort of makes me think about is, of course, we've seen a very big chunk of supply come out of and as always, whenever you're in a sort of a low price environment or a high price environment, the sort of temptation is for it to be just kind of assume it'll be there forever. But I think it's entirely possible. We've seen a big chunk come out of supply. It's not impossible that we'll see volatility upwards or downwards, in the oil price. But this is really when companies have to be at their most vigilant. So let's say we come out of the other side. Let's see, assume we have a scenario where the world comes out of lockdown sort of fairly quickly. You can't replace that supply, and you end up with high prices. That's when the real challenge comes in. It's easy to not to make these assumptions and make these statements when you're at a lower price level. But to go back a couple of years, $100 oil. Companies thought it was going to last forever, and that's where they blew all the money. So I think situations like that, where you have a bit of upward volatility, will be the real test, sort of after the coronavirus issue.
Right, Andrew, you mentioned earlier an arms race a little, I believe, and we're already getting some questions, about the growing gap between European and North American companies. And so one of the questions that we've received is, what do you all think it will take to narrow that gap and to change the approach of some of the large U.S. corporations?
Well, I'll let. I think Caroline is going to be the expert on this one. But I think one of the things I think there's a couple of different things. I mean, clearly, I think there's a little bit of a cultural difference. The European debate has, for a long time, probably been a few years ahead of the other side of the Atlantic, and that was kind of that. And we've seen that in terms of the a lot of kind of the investor discussions were happening quite a long time ahead in Europe than they were in the US. I think is the reality. That's not the situation. I don't think that's a situation that's going to be the same forever. And I think we're getting more and more interest from North America-based investors and of course, other stakeholders, civil society, wider stakeholders in the rest of the general public. But I think I'm sure Carolina would agree with me. The investors have been a very big part of the solution. Clearly, the US oil companies have a different clientele of investors. And they probably still perhaps feel that they're being pulled a little bit in different directions, whereas perhaps the overall direction of travel is a little bit clearer in Europe. But I'll pass on to the expert for that one.
Yes, I don't know how much expertise I bring to this question, but I can affirm this diversity of the investor base. But I'd say that the trend is probably, I get the impression in talking to the companies that they're hearing much more of a concern about the climate question. Even if investors, it may be less common in the US to have an explicit Paris alignment objective from the investor, but seeing how that is impacting the valuation of some of the companies that have been potentially more resistant to that, to taking action. I think there's just greater awareness of that. But to answer the original question directly, I think it really comes down to policy. There's such a dramatic difference in the policy environment in the two regions, and that will make all the difference in creating the appropriate incentives to really make progress on the issue. And I think probably would be helpful for the oil and gas companies to just have some clarity about the future and planning and some, they'll be getting credit. Those that have been doing better on things like methane emissions will have a framework to get credit for that.
Okay. And, one of the things that people are asking is, what kind of changes and, at what level of, ramp up of those changes are you all looking at in order to meet some of the, to meet goals from the Paris Agreement? What are you specifically looking for either in the next 5, 10 years, whatever time frame are you expecting to see, or what are investors looking to see over that time?
Okay, well, I'll just go briefly and then pass on to Carolina for the investor perspective. But I think so. We tend to sort of a carbon tracker. We tend to focus on the sort of narrow aspects of it. We focus really on the kind of the project portfolios that companies have and the extent to which they are or are not competitive. When you put them in a model with low carbon assumptions, shake it around and see which comes out. I'll try and understand the way that companies are either managing their portfolios for the future or sanctioning assets now that may or may not appear to be based on the assumption of the failure of Paris targets. So we'll be keeping a very close eye on that sort of thing. We publish reports looking at which companies have sanctioned what and the extent to which it fits in. But clearly there are a lot of different aspects to this. Things like lobbying has been a very big issue. People want to see from their companies not just that they have low carbon portfolio, but that they're not actively trying to undermine the prospects of a benign climate outcome for everyone else. And there's all sorts of clearly things like governance issues. I mentioned earlier the fact that around about 9 out of 10 oil and gas CEOs are incentivized to increase production or reserve volumes. Now that's something that clearly doesn't make sense from a climate perspective, but it also doesn't really make sense from an investor perspective. I mean, why would you just incentivize a company to get bigger for the sake of getting bigger? Why not incentivize based on things like returns, which companies do, So, but if you've decided you've got a strategy of value over volume, why incentivize based on volume? It makes no sense. So that sort of thing feels like the lowest of low-hanging fruit, and yet apparently it seems to be quite a difficult thing to get rid of. But I'll stop there and pass it to Carolina.
Sure, that's a great example, something we've been working on for several years, even outside of the climate context, and it does take time to create change, although there's some progress. But I guess coming back to your question, Carlos, I think that I mentioned before, I don't think there's a one-size-fits-all approach here, and I think we have to meet companies where they are. Each one, it has a unique combination of skills and opportunities, strategic options. And I think that the global energy system is not going to change overnight. It is a transition after all. I don't mean to imply that embracing a business as usual option is sufficient though, because the transition is underway. It will likely accelerate from here. The decarbonization pressure is going to continue. So what ultimately that comes down to is companies need to really plan to skillfully manage through the transition. And that's what investors are expecting from them. So for me, it really comes down to whether they have a plan to do that. Do they have a strategy, and is that strategy credible? And engagement, in addition to being an important tool to help us give feedback to companies, can also be really helpful in helping us gauge the credibility of companies' strategies. And we have the opportunity to meet with different levels of companies, board directors, management teams, different functional lead sustainability teams. So really putting that mosaic together and having those conversations helps us test that, corroborate what we're reading in companies' sustainability reports and announcements. And I can offer a couple of examples on this point. The first one gets to this compensation question that Andrew raised. So there was one discussion I had with a board director of a European energy company about their executives' compensation plan, and the discussion was not focused on climate. It was really about informing our approval of their plan for that year. But I did push them on why they had oil and gas production targets in the plan. They added some of the carbon reduction targets, but they kept those volume targets there as well. And especially in the context of their recent announcements and commitments to do more, why would they, where's the strategic alignment there of maintaining that? And this director said, well, we're an oil and gas company. So that is true today, but I think it just reflected the mindset potentially at the board, and just gave us one more tile in the mosaic to question, well, maybe the credibility here of that plan and the potential for execution is not going to be as strong in this case as others, where we're getting a much more clear message across a company about their plans. In another example, I asked a US company whether some of the elements of its climate plan were feasible. Did they think they were achievable in the near term? And they conceded that probably not, that they didn't see it as likely to really materialize. So is that plan credible? Maybe not. And then conversely, there was a positive example. There was a CEO of a smaller company, an offshore producer, that came to us proactively and wanted feedback on their decarbonization plan. They wanted advice, feedback, passionately articulated the business case for doing this, drew the links to investability for the company. And we had, a good conversation. They're acting on those plans, and for that engagement, I could really confirm the credibility of the plan there. So I also wanted to touch, as a final point, the emerging market companies I mentioned before. I think this is a unique case. I mentioned some positive surprises of companies that are taking it seriously, but I think we also have to acknowledge when we set expectations that they should be realistic and really consider the incentives and unique constraints that could be in place. And in some of these emerging market national oil companies, they're large employers of within their countries. The revenues from the fossil fuel production are funding important social programs. So diversifying the economy and aligning with the energy transition, it's a lot to tackle at once. So I think this is a clear example of meeting companies where they are and really encouraging improvement from there. And even recognizing these challenges, I think there's still plenty of room for credible progress that can demonstrate they can be part of the solution.
Okay. And we have a question based on just, I guess, some of the rhetoric, but, I know that BP has talked about changing from being an international oil company to an integrated energy company. And, people have said serious decarbonization could, threaten the future of these companies as oil and gas companies, which you just kind of spoke to a bit there. So we have a question here that says, why do promoters of engagement believe so strongly that fossil fuel companies are well placed to become renewable energy experts? And they offer an example with the utility company Ørsted.
Well, I mean, also the company that have done it very well. So, this is a company that back in, I think it was May 2017 or so, that sort of time, they announced they were going to sell all their oil and gas business to INEOS, which is a British chemicals company. Since then, their share price has gone up by about 250%. the S&P E&P index has gone down by about 65. So they've made a real success of it, and they've hugely outperformed their old peers. I think the way I've talked about a lot about trying to fit your oil and gas portfolio within a carbon budget and the limitations that puts on it. So we really see that as the first step. The first thing to think about is making sure that your fossil fuel arm is competitive, and that over time is going to mean getting smaller. Then you've got a question after that of what do you do with that money that comes out of that? You can either broadly return it to shareholders for them to invest in other things as they see fit, or you can try and take a view where you invest in other things and other sectors and diversify that way. Problem with both of those is they're both quite challenging from the point of view of an oil and gas company. So with the kind of the wind down model, where you're just returning all the capital, that might make a lot of sense in terms of from a financially rational point of view. But if you're you're an executive there, it's quite a difficult thing for you probably as a human to say, okay, the company's going to get smaller, pay me less every year, we're going to sack 100 workers every year. It's a very, very difficult thing to do. And I think Michael Jensen, in fact, he's an American economist, wrote a very interesting article about this back in mid-80s, which was about the principal agent conflicts of interest between shareholders and management. And he made the point that when companies have excess cash flow, that executives are actually normally incentivized to spend it in NPV negative projects before they actually return it to shareholders. And shareholders can, of course, try and limit this discretion by demanding higher distributions. But the example he actually gave at the time was that of the US oil and gas industry in the 1970s, when there were high oil prices, companies found themselves with all this excess cash, didn't know what to do with it, and they invested it in other sectors, things like shopping malls and stuff like that. And the net result was that they blew a lot of money, destroyed a lot of value by investing in assets that have returns below the cost of capital. So which kind of points to the issue with the other aspect, the kind of diversification angle. These companies that are trying to move into other sectors, they may or may not have the expertise to deal with. Now, clearly, Ørsted have shown that it's possible. So that's the good news. I think with the other companies, we're going to have to wait and see. It's one of those things where literally time can tell, and it's a big question for management trying to convince their shareholders that they have that strategic clarity and that view and the skills to be able to deliver it. Maybe it's not a case of developing those skills in-house. Maybe they buy them in. Is probably an easy way of doing it. But I think one interesting data point, because there's not a lot of them around at this point, is about of course when BP announced this huge investments they were going to make in low carbon forms of electricity, they're cutting their oil and gas production by 40%, they're cutting their dividend by half. On the day their share price went up by 7%, which kind of just illustrates that the appetite certainly is there for investors if they are willing to lay this out with a certain degree of specificity and really tell a good story around it, and then investors appear to be willing to support it. But in terms of who's going to be successful, I think that remains an open question.
Yes, I agree. I just add that I don't think anyone believes this will be easy. But I think what may be left out of the question is, or what I would add to the question is, there's also a risk in doing nothing. Back to this idea that the future is going to look really different from the past. Carbon budgets will be constrained. The need to adapt to that still remains. But even as an engager, the message doesn't always have to be shift to renewables. It's really considering. It has to be a good plan that makes sense and considers the company's options, skills, and ability to deliver to their investors and align with the transition at the same time.
Mm-hmm. And looking at that, do you see the level of investor scrutiny increasing, maybe over the recent years, just in terms of assessment of how do you all look at, or what are you looking for in a company's plans, and what makes one company's plans more credible than another? Can you kind of help us with that?
So we don't have a lot of plans yet in terms of the detail. We don't have a lot of experience with that yet. So that is really the next step, is to is to understand beyond the commitment, how will companies get there, and then understand how, if it's credible and if they can continue, the investment case is still there while they shift strategy. That again, it's not an easy task to contemplate, but that challenge, and it comes back to thriving through the transition, managing through it, and really continuing to deliver to investors in the short term through to the long term. So at a high level, that's what we're going to be looking for.
Andrew, did you have any thoughts there?
I think that's quite right. We have done quite a lot of analysis of the company's emissions targets, or ambitions, I should say, rather than targets. They're sort of never framed as targets because that has a very specific meaning under SEC law and gives all sorts of binding connotations. So they don't tend to frame them in those terms. We've done a lot of analysis along the extent to which are these fit for purpose? Do they actually match kind of the concept of a finite carbon budget, or do they just are they a fig leaf that allows the company to sort of get bigger and bigger and bigger over time and sort of just continue business as usual, whilst adding other different parts? The bit around, okay, so firstly you've got to lay out an investment, an emissions ambition that's credible and delivers results and is commensurate to the issue. Then you've actually just got to go and do it. And that's the bit that's really lacking. And in some ways, at the long end, that's not totally unreasonable, because a lot of these companies probably don't know quite how we're going to get there. The simple fact is that the state of technology in 2040 or 2035 is going to be quite different to how it is now. But at the same time, so that's kind of in the longer term. But clearly, we can't just wait and hope that some sort of technology just comes along and solves the issue and ties a neat little bow on it. Hopefully that doesn't seem very likely. So the important thing for companies is to really be able to show that they're making changes really in the near term and they're meaningful, and deliver that clarity on what their plans do. And I think that probably is one of the issues where I mentioned Shell started off this as one of the leaders. I think this is one of the areas that they've perhaps been left behind a little bit when all the other companies have sort of been falling over themselves to increase their ambition and sort of give more detail on this. I think a lot of detail is lacking sort of across the field, but that's certainly what as Caroline said. I mean, this is the big area. They've made the claims. Now they've got to deliver.
And we're getting close to our time, but I wanted to ask one more question, just in terms of when we're talking about credibility, how do these companies address, their legacy and their reputation, and how long it's taken them to come to the table in terms of accepting climate science? How does that impact their ability, to achieve these climate targets going forward?
Yeah, you got to say that there's probably been a lot of potential goodwill has kind of gone. People assume the worst when oil and gas companies make these claims, and sort of not without good reason, really. That the track record is the track record, and the companies clearly have a job to do in convincing stakeholders, financial stakeholders and other stakeholders, that they are going to be they're going to be able to continue this forward. And there's a break from the past, but for some of this, I think it's going to have to be, or they're going to have to rely on people's faith a little bit, because clearly the track record isn't great. There's no two ways about it.
Carolina?
Nothing to add. I agree. There is a trust deficit and a lot of pressure to regain that trust, and you see lots of companies trying. So it's not impossible, but there is a hump to get over.
Okay. I think we might have time for one additional question. Let me look through here. Someone is asking, what is Wellington's perspective on collaborating with other large investors to lobby oil and gas companies? And do you see potential for coalitions of investors to add increased pressure on some of these large oil and gas companies?
Sure. So we do collaborate with other investors. We are members of Climate Action 100, for example. We have tended to do, we focus our time on the one-on-one engagement because we do have such, long-time relationships with companies. It's natural for us to just continue to bring this up in our ongoing engagements. But I think absolutely the working together with others can really make a difference. And I think it's seen the positive impacts through the Climate Action 100 initiative is a really key example of that.
And I wanted to invite both of you to maybe kind of make some, closing remarks just in terms of, what you're looking for in your respective areas moving forward, particularly as, companies continue to lay out plans and, just maybe, is there cause for optimism? Are you a little bit more reticent there? What is your perspective moving forward?
Well, I think I would be cautiously sort of optimistic. I have to be, I have to confess to probably being taken by surprise at which the speed that this has all happened. Ultimately, I've been at Carbon Tracker since 2014. The discussions I'm having now are a world of difference from back then. Back then we were saying, hey, look, there's all this potential oil. There's absolutely nowhere that doesn't fit anything like a low carbon scenario, and kind of people thought we were crazy in the world. That was world of $100 oil. Clearly, then the conversation has kind of come a long way, and particularly since Paris and the last couple of years, it's been an absolute step change. And we've seen the oil and gas companies kind of laying out things that I didn't think I'd see. So. I think it's good to have that that sort of capacity to be surprised, but hopefully that trend continues. I don't, clearly it's not an issue that's flash in the pan. This is around for the long haul. So I think the direction of travel is hopefully only going to be in one way. Questions of speed, of course. If we're hoping for a 1.5 degree outcome, there's already more than enough oil and gas and coal in existing production. Then it's already going to take us past that limit. So on the plus side, so clearly, companies are kind of assuming something beyond that. But I think you can see from the external pressure, certainly ambitions around climate, pressure on climate is increasing all the time, and people are just continually rushing down that bar of the temperature outcome that we're hoping to achieve. So I'm kind of hopeful that the momentum continues and intensifies.
Carolina, any last thoughts?
So 2 words as I look ahead that come to mind. The first is execution, and the second is incentives. So on the first, I think companies really, next step is demonstrating progress against those commitments. We have a lot of commitments. It's hard to get our arms around them because, as Andrew mentioned, they're all measured differently, but still they're there. And now demonstrating progress will be really important. And the second is incentives. And here I'm thinking about policy and the investors and lenders, financial markets more broadly, how that is changing. And policymakers have a big role to play here on just establishing those incentives and shifting towards a lower carbon future. And there could be a lot of opportunity there. I'll end on an optimistic note.
Well, thank you, Carolina San Martin and Andrew Grant. And we have a lot of questions that have come in, and we'll be taking note of those. Thank you, everyone. Again, Carbon Tracker is hosting a webinar tomorrow on plastics, so thank you for tuning in.